A major investment fund, JPMorgan, has declared that institutional interest in cryptocurrencies is over, stating that there's no longer demand from big players to invest in Bitcoin. At the same time, Dalio, former co-chief of the hedge fund Bridgewater Associates, is warning that we're on the brink of a crisis even bigger than the 2008 Great Recession. In this video, I'll explain why these apocalyptic headlines might not be as innocent as they seem, and how major investment funds could be trying to manipulate the average retail investor's mindset. Are institutions really selling off Bitcoin and exiting equities? According to analysts at JPMorgan Chase, Bitcoin is no longer benefiting from safe haven demand, unlike gold, which has seen strong inflows. The team, led by one of JPMorgan's managing directors, pointed out that investor appetite for Bitcoin is clearly declining. They noted that Bitcoin hasn't been able to attract the kind of safe haven flows that have recently supported gold. They also highlighted that Bitcoin has experienced 3 straight months of outflows from ETFs, along with declining speculative interest in futures markets. In contrast, gold continues to attract steady investment, both from institutional players and speculative traders. JPMorgan argues that despite a reduction in market depth and liquidity, gold remains a favored safe haven asset alongside currencies like the Swiss franc and the Japanese yen. And if we look at the gold chart, it's obvious. Since March 2024, gold hasn't stopped climbing dramatically. Investors are clearly turning to gold as a safe haven amid the uncertainty sparked by the ongoing trade war, which is impacting equities. Now, if we overlay Bitcoin's chart with gold's during that same period, we'll see something interesting. In the beginning, both assets moved together, broadly speaking, in a strong upward trend. That much is undeniable. But later, things change. When you look at the yellow line, that's Bitcoin. You'll see a sharp decline in price. That drop closely mirrors the behavior of U.S. indices like the S&P 500 and the NASDAQ. Meanwhile, gold kept climbing. It kept finding value. So yes, what JPMorgan is saying is technically true. Investors are leaning toward gold as a store of value instead of Bitcoin. They haven't lied. But that's not really the point here. The real question we should be asking is why now? Why is JPMorgan, one of the most powerful players in global finance, coming out at this exact moment to tell us something we've all known for quite a while? Honestly, raise your hand if you think the average retail investor, whether in crypto or equities, still believes Bitcoin is being used as a safe haven right now. Because the truth is, most people already know it's not. So why the reminder? Why the drama? Everybody already knows this, but there's something we're overlooking. Why is a major investment fund coming out now to remind us of something so obvious? Why are they giving us this extremely negative news about Bitcoin and the crypto ecosystem? Something that's clear to everyone, but choosing this particular moment to do it? Think about the timing. Right now, Bitcoin is highly correlated with equities, and we're in a context of massive fear and uncertainty, all fueled by the trade war triggered by Donald Trump. What a convenient time for a major investment fund to step up and remind us of how bad things are. They do it right at the peak of fear when retail investors are already stepping away from crypto, and I'll show you proof of that in just a moment. When you analyze what's happening, it's clear this isn't a coincidence. They want you to believe that investors are turning their backs on Bitcoin and crypto. Remember, all this happens at a time when nobody wants to buy. Very soon, I'll show you clear evidence that leverage buying interest for Bitcoin is dropping off a cliff. These are hard facts. Retail investors simply aren't looking to buy Bitcoin right now. That's the reality. And if you look at the XRP chart, you can see what the average retail investor is focusing on. They're paying attention to basic chart patterns like the classic cup formation, but in this case, it's inverted. According to the theory, once this pattern breaks support, the price is supposed to crash. Retail traders see these basic chart formations all over social media and believe they're guaranteed to work. Just because that's how they're explained online, you can even see traders posting about this cup pattern on XRP, convinced it's predicting a massive price drop. But what these traders and investors don't realize is that these patterns have already been studied in depth, and the scientific research clearly shows they offer no statistical advantage over the long run. Relying on these formations is a huge mistake, one that only beginner investors or those with little experience are likely to make. So right now, the average retail investor is watching XRP and thinking the whole crypto market is about to collapse. But here's the question I want you to ask yourself. Don't you think it's a little suspicious that the big investment funds like JPMorgan are suddenly pushing headlines right at this exact moment of extreme fear, saying, hey, Just in case you forgot, Bitcoin is not a store of value. Bitcoin is bad. It's as if they're just reminding us of something everyone already knows, but they conveniently pick this time when retail investors are already convinced the market is going to crash to crank up the fear. You see how fear is being pushed onto investors right at the moment when, because of their simplistic beginner-level analysis, again, no judgment, we've all been there at some point, they're relying on chart patterns that statistically don't work and are convinced the market will fall. And we haven't even talked about the kind of information retail investors tend to focus on. They often love to follow analysts like Plan B, those who publish theories based on extremely limited data sets. For example, using just 2 data points, they'll say, look, every time the realized price by age, which is that green line, flattens out or stabilizes XRP's price, marked in black drops. So they'll look at it and say, see, the realized price by age calmed down here and XRP dropped. Same thing happened over here. It's happening again now. So get ready. It might crash again. 2 data points. That's it. And yet some people take that as statistically valid and start spreading it like gospel. And what does the average retail investor, still in their learning phase, do? They believe it. They don't know any better. And that's how fear keeps spreading. That's why it's so dangerous to listen to everything that comes out of big investment funds or certain social media analysts, many of whom are either misinformed themselves or worse, deliberately spreading misinformation to the masses. Look at how this plays out. On Polymarket, a poll asked, will XRP hit a new all-time high before 2026? Just a while ago, over 60% said yes. Now, only 35%. That optimism dropped by 25%. That's the impact this wave of disinformation has on the mindset of the average investor. And while people are scared, what's actually happening? Let's take a look at XRP's daily chart. After that strong bullish move, we can see the price is being defended around a key support zone. Every time price dips into it, there's a clear surge in volume. That's not just a pause, it's absorption. Someone is buying heavily every time there's a sell-off. So while retail investors believe everything is about to fall apart, the data tells a different story. These failed breakdowns with increasing volume suggest strong buying pressure. It's a classic sign that the big players might be accumulating while the smaller investors are panicking and selling. Now look at this chart. See that orange line? That's the price of Bitcoin. And below it, you've got the blue histogram, which represents total leveraged long positions. Basically, this shows whether investors are confident enough to bet on Bitcoin rising. And look closely. Since April 17th, there's been a steep drop in these leveraged longs. What does that mean? It means investors are losing faith. They're no longer confident that Bitcoin will keep rising. And you know what that tells us? When institutions want to make a big move upwards, they don't want the small guys tagging along. They want to go solo because retail tends to close their positions at the worst time. When the price moves in their favor, institutions often place sell orders to slow down the climb. That's their real interest, to make it harder for the price to rise. In short, before big institutions push Bitcoin higher, they need to see this kind of disinterest from regular investors. Just look at this. When retail investors start backing off from leveraged long positions, what happens? That's exactly when the price starts rising. The same pattern again, interest fades, and right after, Bitcoin starts to move up. Coincidence? Not at all. It shows how the average retail investor constantly misses the mark. That's why you don't want to act like the collective retail mindset. That's why you want to follow channels like Inform Crypto. Look at this historical example. When leveraged long interest in Bitcoin suddenly collapsed, what did price do? It went up, clear as day. So now I ask you, which side are you on? Are you following what the average retail investor is doing, or are you starting to understand the manipulation that big institutions are embedding into the market narrative? And now I'm going to show you how whales, those massive funds and players, are absorbing Bitcoin right now. But first,
welcome to Crypto Insight, your ethical and moral channel for cryptocurrency technical analysis. Here, we really know what we're talking about. We conduct advanced technical analysis that has been developed for over 12 years. We upload videos several times a week. If you're enjoying what you're seeing, let me know and leave a comment with your opinion. Like the video, subscribe to the channel, and click on the bell so you don't miss the next opportunity.
Yes, Bitcoin whales and sharks are absorbing BTC at record-breaking rates, over 300% of the current annual issuance. Meanwhile, exchanges are losing coins at a historic pace. In other words, the retail crowd is fleeing the market, scared and hesitant to invest, while the largest wallets are hoarding Bitcoin like absolute maniacs. The biggest holders, those with between 100 and 10 BTC, are accumulating more than 3 times the current issuance. This marks the fastest rate of accumulation by whales and sharks in Bitcoin's history. Take a look at the histogram below. It shows the yearly absorption by these whales and sharks. What we're seeing is that since late 2024, the absorption frenzy began. And honestly, we're not surprised. If you've been following Crypto Insight and watching our videos, you already know we've been considering this exact scenario. Now, it's not just speculation, it's gaining serious traction. We've seen a huge spike in accumulation, especially in early 2025. And if we zoom in on the light blue line here, you'll notice it's still trending sharply upwards. So while the media screams about trade wars and JPMorgan says beware of tariffs, while Trump throws more gasoline on the fire and investment funds feed the panic, look at what's actually happening behind the scenes. And in just a second, I'll also show you how here at Crypto Insight, we had already positioned ourselves in anticipation of the breakout you're seeing now. But first, let's zoom in on the wallets holding more than 10,000 Bitcoin. Take a look at the blue areas. Those represent whale accumulation. Now notice how the red areas reflect distribution phases. Accumulate and Bitcoin goes up, distribute and Bitcoin goes down. And right now we might be entering another potential accumulation phase, as you're seeing here. Obviously, if institutions are accumulating, they're not going to put out a press release saying, hey, we're buying now. No. They'll publish headlines like, it's risky out there, or the market looks ugly, just to scare you, so you'll sell, and your panic sell becomes the perfect buy opportunity for them. As we mentioned in previous videos, we've been anticipating the break of this structure for a while, and from that point on, we've been focused on the possibility of a bullish breakout. Just look at how we explain this with Bitcoin. We've been saying for some time now that we came from a distribution phase that led to a strong upward move, which was then followed by a descending channel. So in midterm terms, as long as the top of this descending channel doesn't get convincingly broken to the upside, we're technically still in that bearish channel. Now, if you ask me whether I think this structure will eventually break to the upside soon or eventually, my answer is yes. I do prioritize the bullish breakout scenario over continued decline. In fact, we've been leaning bullish even from lower levels, and that's something we've covered in past videos. Let me show you just the latest developments. In our private trading community, Crypto Insight Premium, where we do live intraday market analysis, we had been evaluating that if Bitcoin didn't lose this defense zone when price was still down here, the whole crypto ecosystem could bounce. And that's exactly what we were expecting in the short term. Now, as you already know, in my opinion, this market has been held down deliberately. Everything is being slowed down, I believe, since around April 9, right after they baited the market with tariff panic. It worked perfectly for crypto. That moment they finished accumulating, broke the creek, came back for a test to hunt liquidity, and that was our speculation, not just in crypto, but also in the stock market. And in fact, it played out first in the stock market. That was the bet that crypto would follow, and it did. A very positive signal. So now, what are we seeing? They're working this defense zone again, prepping for a breakout, and we're sticking with our long bias. As you know, we've been betting on the upside at 3 key points, and now we're adding a 4th, and so far, it's worked out. Those previous entries were right on point, and this 4th one is showing strong directional intent as well. Why? Because we've been anticipating that while the average retail investor is still paralyzed by fear, institutions are quietly buying, accumulating. I want to introduce you to our private Telegram channel, which is completely free. In fact, at the time of recording this video, we're also live streaming for the community. During these live sessions, we look for trading opportunities in the futures market. We focus on intraday trades, and within this community, members also share their operational ideas, what they're working on, and what they're looking for in the markets at any given moment. It's honestly very interesting. This community is constantly learning and improving. So if you're an active trader and tired of trading alone, you can join our community. It's very simple. The requirements are as follows. You need to be a user of BitUnix or BuyDFI, have deposited cryptocurrencies into your BitUnix or BuyDFI accounts with a minimum value of $100.00, and use this account as your primary futures trading account. In other words, you need to be actively trading. Once you've met these requirements, simply fill out the form displayed on the screen. It consists of just 5 simple questions, and we'll get back to you as soon as possible. And what better time to do it than now? Our friends friends at BitUnix have set up an exclusive promo for new users where they'll cover up to $100 0 cents in losses. So if this is your first time trading and you're looking to join the Crypto Insight Premium Telegram channel, you might want to take advantage of this safety net in case of potential losses. Remember, BitUnix is an exchange that doesn't need a VPN to be accessed from anywhere in the world. To make things easier, I'm leaving you the BitUnix promo details and the Crypto Insight Premium access form in the description and pinned comment of this video. We talked about how JPMorgan conveniently came out right now to spread fear, reminding us that Bitcoin is not a store of value. And now some very interesting comments have surfaced from none other than Ray Dalio. Ray Dalio is warning that President Donald Trump's tariff policies could trigger a crisis even greater than the 2008 Great Recession. He says we're at a critical turning point, dangerously close to a recession. He argues that history tends to repeat itself. Factors like tariffs, ballooning debt, and the growing clash between the emerging power of China and the established power of the U.S. have always preceded periods of extreme instability and global power shifts. Dalio's outlook goes beyond just a regular recession. He warns about a possible depreciation of the dollar, an increase in internal conflict, and rising geopolitical tensions, possibly even leading to military confrontation. All of it with a devastating impact on the global economy. Now, before I share my own thoughts on what Ray Dalio might be trying to accomplish with this narrative, coming from someone who was once co-head of one of the world's biggest hedge funds, let me ask you, what do you think his real intention is with this kind of interview? Let me know in the comments, because these statements, anyone on Earth would interpret them as extremely negative. But if we look at them coldly, what Ray Dalio says actually makes sense. His theory on the macro cycles of empires throughout history is strong, well-researched, and compelling. That's not the issue. The issue is how conveniently timed his appearances are. Every time there's geopolitical tension or macroeconomic turbulence, every time the U.S. enters economic danger territory, Dalio appears like clockwork with a doomsday warning. And let's not forget, he's the former co-chief of Bridgewater Associates, an absolute giant in the hedge fund world. Sure, he no longer runs it, but do you really believe he doesn't have friends in there? You think it's not incredibly convenient for them when he goes public saying the world is heading toward a catastrophic imperial power shift? They flood the airwaves with fear. And there's always a reason. There's always a deeper play. Nothing in markets is ever random. And yes, we are in a fragile moment. Nobody is denying that. Donald Trump is clearly losing control of the situation. Just look at what he posted on April 21st on Truth Social, his own social media platform. He said preventive rate cuts are being requested by many. He added that with energy prices very low, food prices falling significantly, and most other things trending downward, there's practically no inflation. No inflation? Really? What kind of happiness cigar is Trump smoking to say that? Okay, to be fair, yes, inflation has cooled off a bit in the latest readings, but still, let's stay grounded. He even called Jerome Powell, head of the Federal Reserve, Mr. Too Late and a major loser. Trump demanded his resignation, saying it can't come soon enough. Meanwhile, the Fed is expected to maintain its wait-and-see stance at the upcoming May 7th meeting, with markets currently pricing in only a 13% chance of a rate cut. Clearly, Trump needs those rates to come down. And why? Because it's being studied that this entire tariff war was engineered to strangle the stock market and the economy, to force the Fed to cut rates. That's the goal. Lower rates mean cheaper debt payments. And with massive debt deadlines approaching, Trump and his administration are desperate to reduce borrowing costs. In their heads, it was the perfect plan. Apply trade pressure, tank the markets, and push the Fed to cut. They thought it was poetic, but it backfired. The bond market entered dangerous territory. Pressure on the economy grew so intense that the stock market reflected it all, and now they've had to backpedal. Trump no longer holds the upper hand to keep playing with his toy. So now he's going on the offensive, openly demanding Jerome Powell's head. He wants to replace him with someone who will do what he says and slash rates, because through his original strategy, he can't force it anymore. And that leaves us with one question. What are we supposed to think about all of this? Looking at the SP 500 chart, the benchmark US index, we can clearly see that this drop is fueled by fear. Fear driven by Trump's trade war and everything that could come with it. If that toy Trump was using to push prices down has now broken, meaning he can no longer use it, we have to pay attention. We saw how the Fed stepped in and said they'd be willing to inject liquidity into the economy to prevent the stock market from collapsing and dragging us into a recession. So now we have a cocktail. Trump's downward pressure tool has broken, and the Fed is signaling it's ready to do whatever it takes. They've already said they'd be willing to go back to what they did before. And you know what that means. Money printing. Inflate the bubble? Yes. Spark more inflation? Yes. But save the economy in the short term? Absolutely. And look, we're not here to pass moral judgment, or actually screw it. Yes, this is terrible for the long run, but we're speculators. We analyze what could happen in the markets, particularly Bitcoin and crypto. So if it makes sense that US stock indices will rise again because of all this intervention, and we know Bitcoin is correlated with the SP 500, then yes, it also makes sense to expect Bitcoin and crypto to rise too. And there's more. The European Central Bank just announced a 25 basis point rate cut, bringing the deposit rate down to 2.25%. That move was in line with market expectations. They also removed the word restrictive from their monetary policy stance, although they didn't quite call it neutral either. This shift suggests more rate cuts could be coming, especially given the growing political uncertainty, much of it stemming from US tariff policies and their potential negative impact on European growth. So, unlike Jerome Powell's Fed, the European Central Bank has already started cutting rates and is pointing to a more accommodative stance going forward. That tells us one thing. Europe's central bank does not want the markets to fall. They're tightening their grip on the wheel. Now, if Donald Trump manages to pressure Jerome Powell into cutting rates too, that would add even more fuel to the fire. But even if he fails, the Fed has already said independently that they'd consider bringing quantitative easing back to the table. We're watching central banks move. The European Central Bank is already acting, and when you do the math, the pieces start falling into place. And here's another bullish factor for Bitcoin. Over 70 crypto ETFs are currently scheduled to be reviewed by the US Securities and Exchange Commission this year. That's huge. According to Bloomberg, the list includes proposed ETFs that hold a mix of assets, from altcoins to meme coins to derivative instruments. On top of that, more than 80% of institutions say they plan to increase their crypto allocations in 2025. That's from Coinbase's March report. Now, analysts are being cautious. Just because an ETF gets approved doesn't guarantee mass adoption, especially for those funds tied to obscure altcoins. But still, the trend is clear. The institutional interest is growing. Now, look, this is one point where I do agree with the analysts. Just because a bunch of crypto ETFs get approved doesn't automatically mean institutions are going to adopt something like Dogecoin and start buying it like crazy for the long term. Of course not. That doesn't make sense. But it would be naive of us not to recognize the potential in all of this. We're seeing how a regulated market built specifically for institutional capital is being structured, and the fact that there are 70 Bitcoin ETFs still pending approval by the SEC, that's a very good sign. Even more so now that Paul Atkins has officially been sworn in as the 34th chairman of the U.S. Securities and Exchange Commission. Remember, he's a close ally of Donald Trump. The announcement came on April 21st, nearly 2 weeks after his position was confirmed by the U.S. Senate in a 52-44 vote. On April 9th, Atkins stated, "I'm honored by the trust President Trump and the Senate have placed in me to lead the SEC. As I return to the commission, I'm pleased to work alongside my fellow commissioners and the dedicated professionals of the agency to advance its mission of facilitating capital formation, maintaining fair, orderly, and efficient markets, and protecting investors. Together, we'll work to ensure that the U.S. remains the best and safest place in the world to invest and do business." It's widely expected that Atkins will lead a crypto-friendlier SEC, especially when compared to Gary Gensler, who served under the Biden administration. And there's more. His own financial disclosures show up to $6 million personally invested in crypto assets. So here it is. We now have a new SEC chairman who's not just a friend of Trump, but also clearly pro-crypto, someone who will likely push forward ETF approvals and work toward building favorable legislation for the crypto space. So fundamentally, in the long run, and considering that Trump's entire tariff game may end with a favorable outcome, as we've explained throughout this video, our view is that Bitcoin and crypto have a solid future ahead. So if you're hearing these fear-based headlines from JPMorgan trashing Bitcoin, or Ray Dalio warning about a new world order and an inevitable global collapse, pay attention. Pay attention to how retail investors continue to misread the market. They're selling XRP, selling Bitcoin, while institutions are buying, quietly going long. And let's not forget, Trump's toy is broken. The Fed has already said it's willing to print more money if needed to prop up the stock market. Now, with Trump's ally sitting in the sex chair, friend, don't get swept up in the fear. Let's stay positive about Bitcoin and crypto. And hey, if you found this deep dive analysis helpful, let me know in the comments. Drop a like on the video, and don't forget to subscribe to the channel. Hit the bell so YouTube lets you know whenever we post new content. Think smart, don't fall for the traps, and I'll see you in the next one.